Hey, so in this lesson, what I want to talk about actually is the balance sheet. I know we've already had a lesson on the balance sheet, but that's just making it. What I want to do with what this is, our first sort of analysis lesson, which I'm going to, my goal is to thread these throughout the course at, sort of strategic points after we've learned what we need to be able to delve in farther into accounting and use it and apply it to sort of real life situations. What I want to do is talk about some of the things you can do with the balance sheet and some of the things you can't use it for, rather than just knowing how to make it. So some of that more insightful stuff. In other words, applied accounting. And to do this, we have three really short cases. And I'm not going to go through those now or open them up even in the video. What I am going to do is direct your attention to the top of our syllabus. Go all the way back up here, and you see there's important references, things that you need throughout the entire course. And the two that we need to be able to do this first analysis is going to be the chart of accounts and our gaps, which are essentially the rules of accounting. But before we even delve into either one of these, we need to talk about a couple of things that I left for this lesson. I perhaps could have put in the very first lesson, but I didn't. I saved it. And the one thing we sort of didn't talk about was what actually is the purpose of accounting. And really, the realm of accounting, if you can read this, because my writing is pretty lousy, but in the realm of accounting, there's sort of two universes. There's one you can't learn in high school, which is management accounting, sometimes called cost accounting. And that's internal. That's really, as you can imagine, that's what management uses to make decisions. So these reports are very different than the ones you learn about in grade 11 or grade 12 accounting, or maybe your first accounting course at university. And this is distinct from what's known as financial accounting, which is really public accounting, right? And what that means is you make these statements, you produce balance sheets and income statements for the public, for people who don't work for your company. In other words, union representatives, people who have lent your company money, investors who want to know how things are doing, a whole bunch of other people, the government for tax purposes, whatever. So that begs the question, what is the purpose of accounting? So I guess the best way to explain it, the way I usually explain it, is that accountants keep track of transactions so that they can produce these reports. And essentially what they're doing then is it's to produce information, and to be clear, it's useful information for decision making. Again, all of those outsiders are going to take the information you provide and they're going to use it for analysis, to whether invest in the company or not. They're going to use it to decide whether this company can take on more debt and can pay you back in the future. A whole bunch of things it's used for, but in a nutshell, it's used for decision making. And useful we can break down into 4 other meanings. So let's take a second and make useful more clear. So first of all, useful means timely. And timely means if you're going to look at how much profit a company has made to make a decision this year, you don't want information from 10 years ago. That's not useful. Second, it needs to be relevant. It needs to relate to the decision you're making. It needs to relate to financial transactions, et cetera, et cetera. And reliable is perhaps one of the most important. In other words, it has to have been done correctly, and it has to be truthful, so that the people who are making these decisions, of course, are going to rely on your information. So if it's false deliberately or just from incompetence, it's not useful information, right? And then lastly, accounting is done in a fairly sort of standardized method, the way that information is presented in the statements, as well as the processes used to collect and gather the information and record transactions in the first place. So that all relates to a user being able to understand what they're looking at. So it has to be understandable, relevant, timely, and reliable. That's what useful actually means when we write it. And that's what accounting is. That's the purpose of accounting. But we elaborate even more on the rules of accounting, and they all relate to making this information useful. They all relate to the purpose of accounting. So remember this, because I'm going to ask you more than once to be able to explain some of our rules of accounting in terms of how they help make useful information for decision making. The first of these additional sort of rules that we're going to talk about can be found in our gaps, right? Right here. Generally accepted accounting principles in Canada, right? And that can be found right here. There's about 11 of them, but we're only going to do them as we encounter them. The first you're going to need is the business entity concept. So when you're doing these cases, these short cases, the business entity concept in everyday English means that you have to keep the affairs of the owner separate from the affairs of the owner's business. So if you think about it, if the owner takes business money to buy groceries on the way home from work, that's not a business cost. It's not a business expense. And how does that relate to the purpose of accounting? Well, when you look at expenses for the business, you're trying to gauge how well the business is doing, how effective the business is at making a profit. So if you're including home expenses, it's not useful. You're combining an individual's life with the individual's business, and you're getting a mirrored muddy picture of how much cost the business is facing when it operates, because those groceries and other bills, they're not supposed to be in there. So you have to keep business and personal costs and business and personal income separate for reporting purposes. And this is why we started with the forms of business ownership, right? That a sole proprietorship, it's income and your personal income from maybe a job, legally, it's all the same thing. It's all put together. So if your business gets sued, your personal assets like your home are at risk. They can be taken. So legally, it's the same thing. But in accounting, we have this business entity concept, and we keep the two separate. The next one you need is the cost principle down here. Some of the questions you're going to be asked, some of the things you have to think about in the cases relate to the cost principle. And the cost principle states that, and this is not always true, but we won't get there for a couple of weeks, a couple of months even. But for now, remember that when something is purchased, and we've never really stated this yet, when something is purchased, for example, you list equipment on your balance sheet as $30,000, that means that's how much you paid for it when you bought it. It's not necessarily how much it's worth now. Some assets go down. Some assets like land or building go up in value. So the values on a balance sheet, in fact, all values on financial statements are historical cost values. They're not market values. That's important to remember. And whenever this is related. So whenever we talk about the cost principle, I always talk about the objectivity principle, because the objectivity principle states that accounting will be done on the basis of evidence. Objective evidence. So not gut feelings, although those eventually, your judgment does come in later when we get more advanced, but you're supposed to have evidence. So in other words, things like a receipt or an invoice. So you don't make up the value of equipment you bought. You should have a bill or an invoice or a contract. So you've got evidence that anyone who looks at it will be able to figure out how much you bought that asset for and how much it's worth. So the objectivity principle really is married to the cost principle. You can't have one without the other. The other resource you need is this one right here. You're going to need it the whole semester until you've got it memorized in your head. And that's the chart of accounts. And really, I've already kind of been through it. This is basically a generic instruction sheet on how you build financial statements. As you can see, all of these accounts, your assets, your liabilities, and your capital, your equity, go on the balance sheet. That shows your financial position. And we'll do the income statement later. But this is the reference sheet where you look to see what is listed, how they're numbered, in what order, and how they're organized and listed, right? Assets break into short-term and long-term. And here's the criteria. If you're going to have it for less than a year, it's considered short-term. If you're going to have it for more than a year, and the key term is provide a future benefit, right? If an asset will be around for longer than a year and will provide a future benefit, it's long-term. And then within each of those categories, here's how you order long-term assets by longevity, short-term assets by liquidity, etc. So this chart of accounts and your gap sheet, you're going to need all semester. So keep them handy. Remember they're there, because you're going to often need to refer to these for things like case studies, etc., etc. So without further ado, I will end this video and take a stab at some of these cases.